The AAI, AAII survey, the Institutional Investor Survey of bullish bearish sentiment, Jack, has bullish sentiment at 28 points, which is down 10 from its historical average, and bearish is up 10 from its historical average. About 40% are bearish on the market. So that's not breaking news that we had another challenging September. We have them pretty regularly, and October will probably be more of the same. A lot of that has to do with the political wrangling, but we're still focused on the areas that we think are going to really matter over the longer term, which is how we handle the monetary and fiscal transformation that are going on. Also, the digital and the climate are the ones we're really most focused on in the near term, because they're the ones that are really driving the markets right now. So, there's a lot of focus on the negatives, whether it's the dysfunction in Washington, which gets better by the moment when you see that Schumer and Manchin might have had a deal in place for several months now. Makes you wonder what the real stories are going to be. But it looks like we're going to be back to not at $3.5 trillion of additional spend, but a lower number, which is actually good for the markets and good for inflation and good for our debt and deficits if we get that spending out well. But we'll be putting more money into the system. That's going to continue. There's a lot of concern about slowing global growth. I think we tend to look at these things in the rear, a little too much in the rearview mirror. For us, we're looking at what's going to happen over the next 6 to 9 months. And clearly we have growth problems, whether it's the Delta variant or China actually taking a lot of actions to slow their economy down. Those are all negatives, and they are playing out, and part of why we have the volatility. Obviously, we still have supply chain problems that seem to be getting even worse in some areas. The climate transformation is well intended but poorly planned, and we're starting to see the strains of that with problems in Europe, problems in China, India, other areas. I think India has, for their coal plants, 3 days of supply right now for their 135 thermal coal plants. Their usual is a little bit higher, but I think their country on average is at 4 days. That's not a good situation. And so how we're managing this transition has been sloppy at best. And you can't solve 35 years or 50 years of bad behavior in 1 year and think that that'll be seamless. So I think it's getting a lot of attention for the right reasons. Inflation is higher than we anticipated, and certainly is running hotter, but we have seen a number of areas where it's starting to come back down. We think a lot of that will work itself out, but that's still an issue. Inequality is a big issue, and it's rearing its head in a lot of different ways. And one area I'd want to point out is on with the Fed. And there's a number of people on the politically who'd like to see the Fed's mandate changed and expanded from price stability and full employment to include inequality and other issues. And I think that's going to have some big impacts. Ironically, the move to push Powell out, which is getting some attention from certain quarters so that they could have somebody more progressive in there, more aligned with dealing with inequality and other issues, is a much bigger issue than I think people understand. It's changing the mandate of the Fed. It's also, I'm not sure what more the Fed can do in terms of keeping interest rates low to help with the inequality. And in fact, you could argue that it's exacerbating the inequality by having the monetary policies that we have in place right now, because the rich are getting richer because of the low interest rates pushing asset values up. So that's an issue that we're only getting part of the story on. Geopolitical tensions, China is as aggressive in Taiwan as they've ever been. I think yesterday was a record number of sorties flying into the air defense zone. So that tensions are going to continue to rise, and debt and deficits we've talked about are quite high. But that's the headlines. That's what everyone's focused on. That's what the market's reacting to in the near term. I think the rest of the story is what people should really be focused on. A lot of what we just talked about is priced into the market already, not all of it certainly, but the market is a discounting mechanism. There's room for surprises, but when you step back, the world is awash in liquidity. We have consumers with $2 trillion in excess savings, corporate cash of almost $8 trillion right now. Corporations have redesigned their debt loads, particularly the strong corporations, where they've taken advantage of low rates and pushed out their debt maturities so that they're taking advantage of basically the zero rates that has been put out by the Fed. That's actually going to create bigger differentiation between the haves and have-nots in corporate America and I think around the world. The other part of the story about wage and price increases is they're not all negative. They support increase in CapEx and increases in consumer spending, which also lead to better productivity improvements, which in turn will lower inflation over time. So that's actually a positive, not necessarily a negative. It's just the rate of change and how we're dealing with those changes. I think inventory rebuilds are not getting enough attention, but the reshoring and onshoring, and we'll work through some of the supply chain issues. And when we work through that, you'll see a lot of the numbers come down. All this is supported against a backdrop where even if the Fed started to taper in the fourth quarter and ends it in the middle of next year, which is what is probably the consensus view, rates are going to stay low well beyond that. And it's going to be hard for a lot of the programs that want to be put in place to help all the people that we're trying to help right now. We can't afford to do that if you have higher rates. So there is a real dilemma of how we deal with the transition and how we deal with the next financial crisis. But as long as you have rates near zero, that's going to be positive for asset values and positive for equities. The other thing that's, I think, is a much bigger story that people are a little numb to right now is the reopening continuing as case counts decline. And we had this spikes and we have a lot of uncertainty around the vaccines and double doses and getting kids back to school and the like. But what happened with the Merck news this week is just more reinforcement of the innovation miracle that's been going on in the healthcare space, which is really going to accelerate the reopening, and that's going to get us back to whatever the new normal is in a faster pace. And I think I just was on the Hopkins website this morning, and there are very few countries that are in an upswing still, and even a lot of the outliers have made significant progress. And you look at Japan, which, Bill, you know these numbers better than I, but probably 6 months ago had only 8% of its population vaccinated and has made dramatic changes to move up. And I think it's surpassed the US. And we're seeing that with a lot of the less vaccinated countries from several months ago are now really seeing an acceleration in their vaccination rates, which will allow all the supply chains and other blockages in the system to start to ease. And I think that's a big element. Monetary stimulus works in a 12 to 24 month lag time. And that's actually something that doesn't get enough attention because it's not just in time media. But the fact is all the money that's been thrown at the problems over the last couple of years, and it's trillions and trillions of dollars, is going to be flowing through the system on a lag time. I think the US and Europe alone are up $8 trillion in their balance sheets for the ECB and the Fed. So that's going to have a pretty powerful effect still in the system, and that's still being put out. So as we see this stimulus in play, that's going to be with us for some time. Again, that's pushing things forward. And then corporate earnings have been quite strong, and they will continue to be, but they're not going to be even, and they'll be managed in a way that I think will create bigger differentiation between the haves and have-nots and really create a better opportunity for active management, whether you're in the private space or in the public markets. So last thing, and this, Mark, goes to what we saw last week in Ohio and in Michigan and Illinois, is that we have a lot of problems as a nation. And this is from a great book called Strategic Vision by Brzezinski, who at the time was known as someone famous in politics. Now he's Minka's dad. But he wrote a brilliant book called Strategic Vision, and it's kind of the vision of the future for the US. And in it, he talks about the assets and liabilities of the United States. And the liabilities are known. We have a fully flawed system here in a lot of different ways. our national debt is high, our financial system could be improved. There are elements of it, and that's what DeFi is working towards. We have widening social inequality. We can't fix that overnight, so we're going to have smart long-term plans to do that. Our infrastructure has been decaying for a while, and we are taking steps to fix that as well. But I think one of the big issues is public ignorance, and we continue to invest the same people, re-elect the same people into DC to carry on failed programs that haven't worked and allow them to behave the way they behaved. So these are real liabilities, and gridlock politics is another one. And that's part of what Anand and Eddie and I were discussing, is the two-party versus a multi-party system, and is it time for a change or not? And there's a lot of case to be made for maybe a multi-party system might be timely for the US. Smarter people can figure that out. But on the other side, we have all these assets, and our overall economic strength has borne itself out over the last 50 years. And we had Japan take a run, and they were going to overtake the US, and they were unable to. China is now slowing down their economy to manage their economy better. I think that's going to continue to put the US in good standing. But I think what we saw last week, Mark, on the tour, is the innovative potential of the US, whether it's what we saw with Centrifuge, whether we saw with Nottingham Spirk, or what we saw in Michigan, and heard from both lieutenant governors of Ohio and Michigan, what they're doing there to create a more innovative economy, I think is just phenomenal. And that's the story that needs to be told better and is not being told enough. And you're not getting that from the headlines. We have demographic advantages, but we need to continue to leverage them. We are a place where people still will die to come here. And I think we take that as a throwaway line, but it's really something that matters. If you're leaving failed states and you look at the challenges with Syria and other areas, and people are really pushing to move, we're a country that people will come and can succeed in. We just have to continue to promote that. Reactive mobilization is something we saw as a real strength with the pandemic. And the ability for people to up and move to new jobs or new opportunities is something that is real, and it's a part of our culture. Our geographic base and our democratic appeal are something that really matters. So I think what we saw last week, Mark, and whether it's, I'm sorry I missed the South Side tour, but fascinated to meet the people that we met that afternoon from it. And also just going around the different cities, there's so much positive going on. And I think as you move away from the coast and into the heartland, you'll see a really different story going on in America, and one that is America at its best. So I'll stop there and open it up for questions or comments.
Thanks, Stephen. Jack, did he come through?
I feel some discomfort revealing this, but he did a splendid job. It was just magnificent.
But you're never fully happy. So if there's one thing or two that he could do.
Yeah. Let Mark ask Stephen, what should we sell and what should we buy as to public securities?
Well, Jack, that would be the stuff that's going down you should sell. And the stuff you want to buy is the stuff that's going to go up.
That's helpful. That's very helpful.
Jack, hey, Jack, buy what Nancy Pelosi buys and sell what Nancy Pelosi sells.
There is an interesting comment to what we're trying to do as a country is where you want to invest. And I think it's pretty straightforward. And we saw that last week, Jack. You want to invest in innovation, and you want to invest in the people that are able to cut costs and manage the input price increases that are going on. And not everyone's going to be able to pass those things on. And that's actually part of what you guys at Centrifuge are doing in Cincinnati, and what they're doing at Nottingham Spirk is taking existing products and making them cheaper and better and longer lasting. And those are the things that are going to matter going forward. So we're still on board with the tech transformation. We think that the climate change issue is going to be one that's going to be a lot harder for us to execute as a global economy. And that means a lot of the fossil fuel companies are going to be a part of the solution, not part of the problem as we move forward. And I think you're going to see that transition where for some time you're going to have higher oil prices, and some of these traditional energy companies are going to be positive plays for the market. I think the commodity space is one that is going to be really interesting to see play out, because there are certain commodities that are so essential to the future that, and the supply chain issues are going to have to be worked through, but you're going to have higher prices for them, and the demands are going to continue to rise. So we still like that area. Same with materials. And I just think the tech sector has to be looked at not as a sector anymore, but you want to look at the tech producers and the tech users. And I raised that because my wife said the other day, I can't believe we had McDonald's in our core strategy. And I said, we do, because they're actually moving into much more of a tech company than they have been before. And she didn't get that. Same with Walmart. They're reorienting their AI to help them with figuring out who the right products, the right markets, and the right consumers are. So we see a lot of opportunities out there, but I don't think you have to rush to put money to work. I think you want to be measured, and I think you want to take advantage of a lot of the price mispricings that are going to occur, because this is an environment full of dislocations.
Hey, Stephen.
Jack, Jack, it's Vlad. I just have one more comment, and Stephen, just invest in Ohio. That's all.
Right.
I thought it was a given.
Hey, Stephen, I'm just kind of curious about something. So there's a lot going on right now. I mean, you have this massive, kind of dislocation in supply chain and delivery within the UK. I think, the price of gas, natural or anything kind of related for heating oil, et cetera, up like almost 20% today. You have a ton of supply chain shock. Commodity prices are up just based upon, what happened through COVID. All of these are great opportunities. I think the one thing is, how do you think through or sort through timing, right? Because, there's a duration play here, which is, okay, I can look at, significant changes in supply chain dynamics by warehousing, right? And more need for 3PLs and more need for going from just in time to just in case inventory supply, kind of management. How long does this last? I mean, where are the things that you think are blips that are good arbitrage opportunities in the intermediate term, right, or near term? And then what are the things that, frankly, from a family perspective, is really kind of, durable, decades long kind of transformational pieces here that, would be a great long-term return out of the things that you just discussed?
Well, you just threw a whole bunch of things in one long question, Rich. So thank you. I think you're right. I think the hardest part, and this is the art and science of investing, right, is figuring out how long some of these things, the dislocations, can last. And I think it's going to be very different in the different areas you go into. So for us, we want to stay away from the tactical short-lived opportunities and really go for the long ones, because it's too hard to get the timing exact. Our business is not about, there are very few people who can time well. We're not one of them. So we take a longer term view and look for the things that are longer life. So we like the chip space for that reason. We like what's going on in the auto space. But what's fascinating about the shift to EVs is how different the companies handled it in terms of how they were good at ordering their supplies, or who cut back on their orders because of the pandemic, and who kept their orders at the same level, knowing that there'd be supply problems on the other side. So I think you really have to go and look at the opportunities company by company, and look at the sectors and the big secular themes that you're playing, and differentiate that way. So for us, the hard ones are going to be, this energy crisis that we have around the world right now, and how that exacerbates the supply chain problems is going to be one to keep an eye on. You talked about the UK and their price problems, and you're seeing it all over. So I think one of the areas you want to realize is that this energy transition is going to take a lot longer than people think, and the governments can only mandate so much before the reality of what we can actually do based on the pricing of the new green energy versus the supply and availability of it, and then also what the supply and availability of the fossil fuel is. So I think as you go through each of those areas, you're going to have to look and say, where do I pick my spots? We think in the nearer term, the fossil fuels are going to get a lot of attention again because we need them. Whether you like it or not doesn't really matter right now. There's needs that have to be filled. In the chip and semiconductor and chip area, I think you have to see how that plays out in terms of what's going on with China and Taiwan. But I think the fear is greater than the reality is going to be. I think nobody sees that end game coming that quickly that China runs in, although if it did, that would be a problem for a lot more than just the chip space. So for us, we think you're going to have to really be very granular and pick your spots. We like the materials sector for certain materials. We like copper for one. We like the steel space in the US. We think with the infrastructure program, that's going to play out quite well for us. You saw Cliffs Resources, for example, just got a big upgrade yesterday. Freeport, others like that we think are in a pretty good spot. We like the rare earth space. There's only 2 rare earth companies outside of China that are really able to produce in a meaningful way. So that's how we look past, I think, some of the issues, Rich, that you're talking about on the short term. I think the other thing that is the game changer, and I'd leave that to Bill Deukler to weigh in, is I think we're starting to see a shift that people haven't caught up to in terms of the caseloads changing. And as that allows us to reopen, a lot of the supply chain stuff will get resolved faster too. And I think we can move forward in a much more productive way as an economy. So global economy. So I think those are the things that I would say play out, Rich.
And just on that quickly, as you were talking, Stephen, I got an alert from New York Times that Manhattan apartment sales surged to 3-decade high. So the whole kind of coming out of COVID to a certain degree from the real estate angle, certainly, 3 decades is a long time in New York City real estate, but there's certain return to normal on that front.
And actually, to Mark's point about the trip last week, how excited were people on the trip? I know myself and others, we talked about it, of being live and seeing the people that we've seen in the Zoom boxes for so long. I think we have a global economy that's ready to reopen. And I think as we get these things pushing us forward in the healthcare area, we'll be able to see an acceleration and easing of these problems that exist today. And that can happen pretty quickly. Remember how fast it happened earlier in the year and how strong it was when we were reopening then. So I think we're on a good course.
Stephen, Jeanette wants to add a point.
Yes.
Yeah, thanks. And maybe it's an offering for Bill, for Stephen, Vlad, anyone on the call who wants to weigh in. We're tracking data in terms of companies investing in intellectual property. So you have to invest in patents before you have market activity. So we see it as a leading indicator. And some of the areas that we're seeing a lot of investment activity include edge computing platforms. We think that's going to go bigger than cloud. We see biodegradable packaging as a growth area. The wireless spectrum management, like the RF communications, not just 5G, 6G, autonomous vehicles, AI cybersecurity, and AI biomedical diagnostics. We see the telehealth growing, but the AI weighing in on diagnostics. So people looking for tech there. Tokenization across industries, not just art. We see it happening in the securities area, food tech. I think that was kind of hinted at in some of your conversations, Stephen. And, kind of also interesting, consumer sleep. We see that as, kind of a big investment and activity area. And I'd love to share EVs, obviously, and the electric power grid reinforcement are areas that we're watching. And I'd love to share some data and get some weigh in on that. If anybody wants to reach out, I'd like to share it with the team, with the group here. Thanks.
Gian, have you published anything about this?
Well, we share our sectors, our data sectors, as a subscription online at patentforecast.com. But I'd love to just privately or individually or with the team share our insights from that, or just send them out. Yeah, we do have some. It's not widely publicly available. We share them with our clients, but I'm newer to the team in the last couple of months, and would love to contribute that. Thanks.
We'd love for you to help lead or co-lead. We have a lot of deep dives that are in the running. So, or you can just brainstorm and we create one. So we've talked about it.
Sure.
So
Thank you.
definitely.
Yeah, this is Vlad, absolutely. Yeah, what you can share, great, because there's several of us here, I think, where there could be some alignment with some of the strategies you're looking at, so.
Well, I was gonna ask if we were done talking about Stephen's presentation.
Never done. I was just.
Okay, 90 seconds, a couple of quick comments. I don't know, and maybe it's because, as you know, what my orientation is, but just a lot of the stuff that I hear Stephen and, 361 fam, when you talk about like this 10 trillion in liquidity, at the end of the day, a lot of this is just going to come down to wealth redistribution. I mean, I've heard what's the saying that sometimes maybe capitalism needs a little dose of socialism every now and then to, shore itself up. At the end of the day, I really think a lot of that is just literally basically just going to come down to wealth redistribution in one form or the other, basically, right? I'm really inspired by how everyone, you could say, felt about coming to the Midwest, and just that, how would I say, congratulations to 361, because one of the things that you wanted to get over was this idea of how much talent and just resources and energy there is in the Midwest. And I think you did a marvelous job, bringing that over in the tour, really. I really, that was just fantastic. Last one, shameless plug for Lauren Taylor and AwokeNet. When you're talking about like public innocence or a lot of the stuff when you're talking about messaging, literally, I have been saying this and this kind of thing in different, sectors, let's say, both grassroots and other stuff I'm involved in. So whenever you guys want to get around to doing like the messaging or whatever it is that we need to do to tackle the public innocence thing, I'm here.
Well, we're going to do all this is just catalytic stepping stones, right? And we're going to do it next week. I'll pop ahead. But did you want to say something, Rob? As I look for this line.
Yeah, just a quick comment that I congratulate you as well on the trip. I did join for some of it virtually, and I thought that was very useful. I mean, I could only get sort of 51% of the energy flow, but the one I joined, I think it was at Columbus with the lieutenant governor. And as you recall, Mark, we have that Union Metals company in Ohio that we own. I thought that was well received between the their content and the exchange. And I think Steve and you had some even virtual Q&A. But I think to the extent that you have future trips like that, building that part in for those that are able to make it that way was a good use of time.
Yeah, that's the new model.